Hey, good morning once again, options traders. And recently I posted a video about a very special three-strike pricing relationship that goes a long way into understanding your strategies and different pricing relationships, but especially for butterflies. And in that video, I just used a specific example where the strikes were equally spaced, such as 95, 100, 105. They were all separated by 5 points. Well, somebody sent an email asking, well, what if they're not equal? Do these relationships still hold? Well, sort of, but there's a slight tweak that you need to do. What is it? Well, let's go find out. And as always, before we do, please be sure to click like and subscribe. It goes a long way into promoting the channel and is greatly appreciated. So a quick review. I'm going to revisit that first video so that this one makes more sense. But in that first one, I posed a question that if we have 3 calls or 3 puts, and that they're identical except for the strikes, meaning it's the same underlying and the same time to expiration. So again, maybe we're looking at the 95, 100, 105 calls. And what can we say about the center strike compared to the other two? Well, the pricing relationship is that the center strike must be less than or equal to the average of the outer strikes. Well, the pricing relationship is that the center strike must be less than or equal to the average of the remaining 2 strikes, or in other words, the outer strikes. So for example, let's say that we have the $95 call, according to a pricing model, is priced at $5.56. The $100 call is priced at $2.28, and the 105 call is priced at 64 cents. So in this example, we're going to take $5.56 plus 64 cents, that's just the 2 outer strikes, divided by 2, that's the average, and that gives us $3.10. And so the relationship says that the center strike must be less than or equal to this number. So is 228 less than or equal to 310? Yes, it is. And that will always be true. The center strike must be less than or equal to the average of the outers. So we also know that the maximum value this $100 call could ever have would be $3.10. So once again, these 3 strikes play an important role for various strategies, especially for butterfly spreads. Well, the question that we want to answer now is, what if we have unequal strikes? So I'm going to change up the numbers a little bit just to make the math a little cleaner and neater. Let's say that we have the 100, 105, 120 strike. Still the same expiration, still the same underlying stock, but notice that they're not separated by 5 points anymore. Now I've got a 5-point separation between the first 2, but I have a 15-point separation in the second 2. Can we still say something about the pricing relationships of these 3 strikes? Well, yes, but here's where we have to make a little tweak. We can't just take the average of the outer 2. We're going to take the outer strike minus the center, or 120 minus 105 is 15. Then we're going to take the outer strike, 120 minus 100, and that gives us 20. And then we're just going to divide them out. 15 divided by 20 is 0.75. This will give us the weights of these outer strikes. So we're going to take 0.75 or 75% of the value of the first strike here of the 100 plus 25% of the 120. So now these are going to be the weights. And we're not going to say that it's less than or equal to the average, because in the first case, the weights were 50%. And we'll see why in a moment. But because they're 50%, we can therefore simplify it and say it must be less than these numbers divided by 2. So now the relationship just simply says that the center strike must be less than or equal to this value, whatever this is. So once you see this, this is really the generalized case. The first one that we saw, when they're equal, is just a special case. So for instance, let's say that we have the 100, 105, 110. Now they're all separated by 5. We take the outer minus the center. 110 minus 105 is 5. We take the outer minus the first strike, which is 110 minus 100 is 10. We take 5 divided by 10 is a half. See, now the weights are equal. So now that we have the weights of a half, the formula is 1/2 times the value of this strike, the $100 call, plus 1/2 times the 110 strike. And we can simplify that to say it's these 2 strikes divided by 2. But see, now we can't do that when we have unequal strikes. We're just going to look at the weights. So in the previous example, we saw maybe 0.75 and 0.25. So the relationship, really, the general form is to say that the center strike must be less than or equal to this value. So if we just want to put the weights in there, remember that the center strike must be less than or equal to this weighted value. So let's go over to an Excel spreadsheet, take a look at an example where we have unequal strikes, and see if this pricing relationship holds true. Okay, so now we're into an Excel spreadsheet, and in this first column we have a list of stock prices. Then we're showing the three strikes that we used in the example, the 100, 105, and 120. And before, this is just calculating the ratio. It's taking 120 minus 105, which is 15, divided by 120 minus 100, and that's 75. So what the formula says is we're going to take 75% of this value plus 25% of this value. And the center strike must be less than or equal to that value. So let's see if it's true. There we get 0.01. So again, that's 75% of that number plus 25% of that number gives us 0.01. We're going to compare it to the 105 value, which is 0. So the question is 105, the value here, less than or equal to this column? Yes, it is. Let's come up to if the stock is at 100. We've got the 100 call valued at 343, the 120 at 6 cents, and the 105 at 157. We take 75% of this number plus 25% of that number, and it gives us 259. And then we're going to compare it to the 105 strike. And so the question again, is the 105 value less than or equal to that value? Yes, it is. And so again, that will always be true. And once we get super deep in the money to where the options are just intrinsic value, that's when they will be equal. So we can see we got pretty close right here, 40.01 compared to 40. But if we go one more row down to the stock at 150, look at that, 45 and 45. And from that point on, we have no extrinsic values, and we're just at parity. And that's the only time that this relationship will show that they're equal. So just remember that anytime you are at the money or near the money, that in this example, the 105 strike or the center strike must be less than or equal to the weighted average of these outer strikes. That's really what this is. We're just weighting it with 75% and 25%. So once again, this is a really important pricing relationship where you can find some opportunities. Are there some favorable skews that you might want to capitalize on? Or are there some unfavorable ones that you're just about to step into trade? But if you understand these pricing relationships, you'll have a better idea of where to look, which trades to accept, and which ones to avoid. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.